Hi, good morning and happy Kentucky Derby week. And a big week for the oils here. We're going to get through the E&P results, which I think will be very positive. So I'm looking forward to that. We've also excited about the backdrop here, notwithstanding the tragic circumstances that have got us up to as high as $130 a barrel of oil. We're still holding over $100 Brent quite comfortably. And if you look at the chart, ex the Russian invasion, it does look like a strong oil price chart, which means obviously that Q2 is shaping up very well. Additionally, the things that might loosen the market are moving in the wrong direction, which is to say on Friday, Exxon announced that it was shutting down Sakhalin, a major oil project in Russia. At the same time, we also noted that March Indian oil demand was an all-time record high. So the price here is not having the effect that you would want, which is to increase supply and decrease demand. We're simply not really seeing that to the extent that we need to bring down prices, which of course is a very strong backdrop for all these E&Ps that will be reporting. We've had fairly disappointing results from the service companies, misses from Chevron and Exxon in the context of the noise of Q1 with pretty strong cash flow, and of course strong cash return announcements, which is the key. So I'm excited this week to see how much these guys are going to return to us. I don't think there's going to be a loss of capital discipline. I think the risk is going to be in M&A as inventory becomes a challenge. What we're seeing here again, further to the idea that the oil price is very well supported, is that we get the March, the monthly data from the DOE shows that US production for the latest month data is available, which was February, actually fell. So again, US production is not rising. And we featured this in our note yesterday on natural gas, where we're also very bullish. We see the whole complex feeding off itself, and only really the Haynesville is growing gas production. Really overall very muted gas production growth from the US, despite $7 gas prices. And again, substitution of production of consumption is not happening, basically because coal is very tight and very highly priced. So it's all adding up to a super environment for E&Ps. We're just a little bit worried about acquisitions from some of the inventory short players. It might be Devon, it might be Marathon Oil. But some of the other guys, if you take an EOG that rounds us out as the Kentucky Derby starts on Friday with their results, they have a long inventory, ConocoPhillips long inventory, Pioneer long inventory, and of course the Canadian heavy oil sands players. Very long inventories, and perhaps the most interesting thing about last week, unquestionably, was Elliott getting into Suncor. I had a couple of interesting conversations over the weekend regarding how to change middle management structures, which is a very tough one, but is essentially what Suncor needs. But we're now positive on Suncor because we think Elliott will do a long-term job, which will be a 3 to 5 year engagement in recovering performance at Suncor, which has been relatively poor. The cash return chart that I published yesterday, I've already had a client come back saying he loved the gas deck that we published yesterday, but I'm completely wrong on Cenovus and CNQ cash return. I'll adjust those numbers and send the chart out later today. Have a great day. Have a great week. Thanks.